Swayam Prabha. Digital India. Educated India.
Hello learners, I once again welcome you back to our course of microeconomics and its applications. Today we will be starting the Unit 4, which is about cost analysis. And today is the first lecture of this unit. I am Dr. Aparna Samudra and I am working with RTM Nagpur University, and I am the course coordinator as well as the presenter of this course. Let us see, learners, what all we are going to discuss in this particular unit of cost analysis. And in this particular lecture, what are going to be our learning objectives? The first thing today we will understand is that what are the various concepts of cost that we will be using. Then, what are the various basic components of the total cost, that is in short run as well as in long run. Thereafter, we will understand the cost-output relationship in short run. So let us go ahead with today's lecture. The first question which should come in your mind is, before we start this unit, is that what is cost of production? What we did in the previous unit was, we had discussed that what is a production function, wherein we had said that production is transformation of inputs into outputs. And there we had also discussed about production analysis in short run as well as in long run. Now, a very natural extension of production is the cost. Whenever a company is producing something, that it is requiring certain inputs to produce the output, automatically there will be some cost attached to those factor inputs which are being used. So this is what we will be discussing first of all. So as I just told you, that in order to produce any good, every firm will use certain factors of production. And the amount spent or the expenditure made on the use of these factors of production is called as the cost of production. So if you are using labor and capital to produce something, so the expenditure which we are making on labor and on capital will be included in your cost of production. Basically, what we are saying is that what will be the cost of production will be dependent on the quantity of production. If you produce more, you would be requiring greater number of inputs. Therefore, you will have to spend more on these inputs, leading to a higher cost of production. If a firm is a small firm, it is producing less. Maybe there is a slack season, so the production is less. So when production is less, the requirement and the use of the factors of production or the factor inputs would be less. So it will have an impact on your cost. So what we are saying is that cost function is essentially a derived function. That is, how much will be the cost will be dependent on the cost of production. It is dependent on production. Therefore, we call it as a derived function. How do we write this? We say if X is the output that the company is producing, then this C, which is the total cost, is dependent on the level of output that the firm is producing. Now, does this cost fall with increase in production? Does it rise? That is what we will be discussing throughout this particular unit. But this is a very important function and a relationship which we have to keep in mind, that cost is a function of the output being produced. Now, whenever we talk about cost of production or cost in economics, it is a little different from the type of cost which accountants talk about. So let us understand what is this economic cost, and thereafter we will understand that how it is different from the other accounting costs which we see in the books of accounts of a firm. So since we are talking about an economic analysis, our focus will be on the economic costs. So economic cost is basically made up of, or it takes into consideration two costs. One is the explicit cost, other is the implicit cost. Now what is explicit cost and implicit cost, and what is economic cost? Let me first define for you what is explicit cost. Explicit cost means the cost which a firm or a producer is incurring because it is hiring or utilizing certain factors of production. So if a firm is hiring labor, the price of labor which it has to pay will be a part of your explicit cost. Similarly, if firm is borrowing capital from the bank, the interest payment which the firm has to make for the use of capital which it has borrowed will be a part of explicit cost. Or if a firm is buying raw materials, then the money which it has to pay will be a part of explicit cost. So all the cost which the firm is incurring because it is hiring or purchasing certain factor inputs is called as explicit cost. Now let us go to what is implicit cost, because this is this particular implicit cost which makes a difference between economic costs and the accounting costs. Implicit cost is a cost which we calculate by taking into consideration the concept of opportunity cost. If you remember, in the first unit, we had talked about opportunity cost. What was opportunity cost, learners? Just try to recall. We had said opportunity cost is the cost of foregoing the next best alternative use of a particular resource. Right? So implicit cost is taking into consideration the concept of economic opportunity cost. That is, if a firm is, basically it's the imputed value of the resources which were self-owned by this entrepreneur who is organizing the whole activity. So self-employed or self-owned resources which the firm is using in order to produce something, that imputed cost is called as implicit cost. For example, if you are running a business and you own a particular building, that's your own building. So you use that building to produce to run your business. If this building you would not have used to run that business, you might have given it on rent. So the rent which you have foregone because you are using this building for your own business enterprise, so that foregone rent will be called as implicit cost. Similarly, you are spending your time in your business, you are arranging this business activity. The next best thing you could have done with this time is you might have taken up a job and earned some income. So that income which you are foregoing, which you would have got if you would have not taken up this particular activity, that will be a part of this implicit cost. So implicit cost is basically the cost which of the foregone income of the particular use of resource which is self-owned. So when we add up both the explicit cost and implicit cost, what we get is called as economic cost. Now what does this economic cost mean? This means this is that cost which has to be incurred so that these resources do not leave your work and go to some other work. That is, this cost is the cost incurred for keeping the resources to moving from their next best alternative. What is economic cost? I will repeat. Economic cost is made up, it takes into consideration both the explicit cost and implicit cost, and it is that cost which is incurred so that the resources keep on doing this particular thing that they are doing and do not move to their next best alternative use. So it is this cost which is keeping them working for you. So that is what is called as economic cost. Whereas when you talk about accounting cost, we only talk about the cost which is explicit, which you're actually paying for the use of resources. We do not talk about this implicit cost, but we talk about it in economics, because if we do not consider this implicit cost, we will not know that whether the resource which we are employing is being used in its best possible way or not. So economic cost, as I told you, is that cost which the firm has to incur so that the resources do not move out of this work and go and work in their, or go and get employed in their next best alternative. Okay, now since we have said that there is a difference between economic cost and accounting cost, therefore there has to be a difference between economic profit and accounting profit. I've already discussed what we mean by profit. Profit is basically the difference between the revenue and the cost. Now, because the cost component is changing when we are considering economics and accounting, there has to be a difference in economic and accounting profit also. Okay, let us see what is the difference. Economists measure, we say in economics, you measure a firm's economic profit as total revenue minus total cost. But what is this total cost in the view of economics? It is inclusive of both the explicit cost and the implicit cost. Whereas when you talk about accounting cost or accounting profit, we will only be saying that it is the difference between total revenue and the firm's explicit cost. Okay, so economic profit is total revenue minus explicit cost minus implicit cost. It is only when the total revenue exceeds both these costs, the firm will earn economic profit. Okay, whereas accounting, we are going to only talk about profit as the difference between revenue and the firm's explicit costs. Now let us see this graphically, that how economists are going to view a firm and how an accountant views a firm. So in an accountant's view, explicit costs are taken and then accounting profit is derived. So revenue minus your explicit cost will give you your accounting profit. Okay, whereas when you talk about economics, you are of course going to take as your explicit cost. You will also include the implicit cost, and then whatever is left out of this revenue will be called as your economic profit. So what do you see? That there is a difference between the value of profit which we derive from the point of view of economics and the profit which we calculate from the point of view of accountants. According to accountants, the profit would be greater because they will not be taking into consideration the implicit cost. So please remember, whenever we are talking about economics and the revenue and the cost, we are taking into consideration both the explicit cost and implicit cost. Okay, so that's the difference. Now let us understand that what are the various measures of costs. Now cost of production may be divided into fixed cost and variable cost. We have already done in your production analysis that particularly in short run the factors of production may be variable or they may be fixed. Variable means the quantity of that input which can be changed, whereas a fixed input is a one where your quantity cannot be changed. So cost of production is divided into fixed cost and variable cost. What are fixed costs? As I said, fixed costs are those costs that do not vary with the quantity of output produced. So those costs which are not going to change irrespective of what is the level of output the firm is producing, those costs are called as fixed cost. Why? Because these are those inputs whose quantity we are not changing. These fixed costs are incurred even if the firm is not producing anything. It doesn't mean that if you are producing Now, if you're not producing anything, there will be no fixed cost. There is going to be some fixed cost even at zero level of output. Whereas if you increase your level of output, then also this cost is going to remain constant. Whereas when we talk about variable costs, they do vary with the quantity of output. That is, as your output changes, your variable cost will also change. For example, the labor cost. As you produce more output and if you require more labor and you employ more labor, your variable cost will increase. If you are not producing anything, your factory is locked, you're not producing anything, this variable cost will be zero at that time. So when we talk about total cost, this means that the total cost will be a sum of the fixed cost and the variable cost. So we say total cost is equal to total fixed cost plus total variable cost. I think it's quite simple to understand. Now let us go further into all these costs. First, we will be talking about total fixed cost. As I just told you, these are those costs that do not vary with the quantity of output produced. So where this, if you concentrate on this graph which we have made, we are measuring cost on one axis and output on the other axis. That is the horizontal axis, we are measuring output. Vertical axis, we are measuring cost. What is the shape of this TFC, total fixed cost? It is horizontal. It is parallel to the output axis, showing that even if your output is zero, you are still incurring some cost. And as your output is increasing, there is no change in your total fixed cost. That is, your total fixed cost is remaining same. It is not varying with the quantity of output. Right? Even when the production is 0 units, still you are incurring this particular cost. For example, rent. If we have taken a building on rent, irrespective of what is the output that we are producing, we have to pay that rent. So it will not vary with the level of output. Similarly, interest on capital, depreciation of the machinery or whatever fixed capital, fixed assets you have, they will all be a part of your total fixed cost, and this cost will not change with the level of output. And very important, even when your 0 units of output are being produced, this cost will remain always. So that is your total fixed cost. Then the other cost we said was the variable cost. That is that cost which is associated with the variable factor of production. What do you see in this graph? We have made this TVC, which is something like an inverted S, where in this graph again we are measuring on the vertical axis your cost and on the horizontal axis your output. What do we see? Most important thing if you see is that when you are not producing anything, when the output is 0, the variable cost is 0. It is 0. And then you see that this as and as your output increases or as and as you start producing more, this particular total variable cost increases. But it is not a linear line. It is not a straight line. You see that there is certain rate of change at which this TVC is increasing. Let us understand what is it saying. Initially, as the firm starts to produce or starts hiring the variable input, the variable cost rises but at a diminishing rate. That is, cost is rising, but this rise in the cost is at a diminishing rate. Thereafter, after this point, your total variable cost is rising, but this rise in total variable cost is at an increasing rate. So what do we see? First thing is that when there is a 0 unit of output being produced, your total variable cost is 0. So total variable cost will always start from the point of origin. As and as the firm starts producing more output, what do we see is that your total variable cost will rise throughout, but this rate of rise of the TVC is different. Initially, the variable cost will rise at a diminishing rate, and then it will rise at an increasing rate. Why does it rise at a diminishing rate initially? This happens because of the law of increasing returns. If you remember, we have talked about your um, law of diminishing returns, where we saw that initially we see that every new person is coming in, marginal product is rising and average product is rising. Means every new person who's coming in is adding more to the production. Right? So production is rising, this output is rising more, and this cost comparative to the output is rising at a slower rate. So cost is rising but less than the change in output. Therefore, your total variable cost will start increasing but at a diminishing rate, because the addition on the output axis is more compared to the addition in the y-axis. Thereafter, when the firm reaches the normal capacity, what will happen is your total variable cost will rise more. It will rise at an increasing rate. Why? Because we are talking about now the diminishing returns which are coming in. Remember, your average product starts falling. Your total product becomes maximum, and then second stage of production, TP is rising, but it is rising at a slower rate. So when TP is rising at a slower rate, means your output is rising less and your cost is still rising. So this leads to your total variable cost rising at an increasing rate. So remember always that your total variable cost will never be a straight linear rising line. It will be something which is an S-shaped curve, where we see that TVC first increases at a diminishing rate and then it increases at an increasing rate. Initially, it increases at a diminishing rate due to your increasing returns. The stage 1 is there of your production. Then there is diminishing returns in your output. Therefore, TVC rises at an increasing rate. So, let us understand the relationship between these three costs: total cost, total fixed cost, and total variable cost, with help of this table which I have made. We have already said that total cost is the sum of fixed cost and variable cost. What do we see here? I have put various levels of output here in the first column. Fixed cost. From 0 to 8 level of output, the fixed cost is fixed. It is 10, means it's 10. Whether you're producing 0, whether you're producing 3, whether you're producing 8 units, your fixed cost is constant. It is 10. What happens to the variable cost? Variable cost is increasing. It is increasing initially at a slower rate and then at a faster rate. What is total cost? It is the sum total of the fixed cost and variable cost. So column 2 plus column 3 will give you column 4. So you see total cost is continuously increasing, right? Because the change in the component is of total cost is because of variable cost, the shape of the total cost curve will also be like the shape of the variable cost, because whatever change is happening in the total cost is because of the variable cost. Let us see this. This particular graph will make it further clear for you. Let us say again, cost is on the y-axis and output is on the x-axis. Now this, let us say 50 is your fixed cost. This is fixed. Whether you are producing 0 units, whether you are producing 13 units, fixed cost remains constant. And it will never start from 0. Then we see total variable cost. What is happening to variable cost? It is rising, starting from 0 and then rising. So variable cost increases with production and rate varies with increasing and decreasing returns which we did in your production analysis. So first variable cost will rise at a diminishing rate and then it will rise at an increasing rate. Now what is total cost? Total cost is the sum of variable cost and sum of fixed cost. So what do you think, learners? Where will the total cost curve start from? Will it start from 0 or will it start from 50? It will start from 50. Why? Because even though your variable cost is 0, but still fixed cost is there, no? So 0 plus 50 gives you 50. So you'll start from this point, and thereafter, whatever the change in total cost is because of the behavior of the variable cost. Therefore, we say total cost is the vertical sum of fixed cost and variable cost. So total cost will also first increase at a diminishing rate, and then it will start increasing at an increasing rate. So these are the three curves: TFC, TVC and TC, and their behavior with the level of output. Remember, when we are talking about variable and fixed cost, we are talking about short-run situation where one input is variable and other input is fixed. Okay, now let us understand what is average cost. Average cost is basically the cost per unit of output. That is, if you divide total cost by the number of units produced, we will get average cost. Second important type of average cost we do is called as average fixed cost, which is total fixed cost divided by the number of units produced, divided by the quantity produced. So AFC is equal to total fixed cost divided by the level of output or quantity being produced. When we see the curve or how does this cost behave, we will see that as and as output rises, average fixed cost will fall continuously. Why? Because the numerator, which is the total fixed cost, is constant. There is only a change in the denominator. Therefore, average fixed cost will continuously fall and it will resemble a rectangular hyperbola. And also remember, total fixed cost will never touch x-axis, showing that output will not be 0. So it will keep on declining, but it will never become 0. Then you have average variable cost, which is total variable cost divided by the quantity produced. So AVC is telling you that on an average, how much is the expenditure on the variable input. And generally, a average variable cost we see as a U-shaped curve. It's a U-shaped curve showing that initially as your output rises, average variable cost will fall. Then it will reach a lowest point and then it will start rising. That is, average variable cost will first fall, become maximum, and then it will start rising. Average total cost is therefore average fixed cost plus average variable cost, or we can say it is total cost divided by the quantity being produced. So we have average cost we will calculate for TC, TFC and TVC. AFC is TFC divided by Q, AVC is TVC divided by Q. Average total cost, or AC, many times it is referred to, is either sum of AFC and AVC or total cost divided by the quantity produced. Now let us see the behavior of these curves. As we said, average fixed cost is a rectangular hyperbola showing the average fixed cost is continuously declining. Average variable cost curve is a U-shaped curve showing that as output is increasing, first your average variable cost is falling, reaches a minimum point, and after this minimum point, as more output is produced, average variable cost rises. So you see this kind of shape of the curve, AFC and AVC. AFC is continuously falling, whereas AVC first falls, reaches minimum, and then it starts increasing. What is average cost? It is the sum total of AVC and AFC. Or it is average cost, total cost divided by output. Average total cost is also a U-shaped curve. Why? Because it is also showing that as your output is increasing, your average cost first declines, reaches a minimum, and then it starts increasing. Also, as you remember, total cost took the shape of your total variable cost. Similarly, average total cost is also taking a similar shape of your average variable cost. Another important concept is of marginal. Now, marginal you have seen everywhere. We have talked about marginal utility, we have talked about marginal product. Now we are talking about marginal cost. What is marginal cost? Using the same concept, it basically measures the increase in the total cost or change in the total cost when more units, an extra unit of production is being done. So if a firm decides to produce one extra unit, the change that one extra unit production brings to the total cost is called as the marginal cost. That is, it is the cost of producing one more unit of output. How it is shown? It is the change in the total cost divided by the change in quantity produced. How much are one extra unit if I am producing? How much change does it bring in my total cost? That is measured by marginal cost. And this is the cost on which the firm exercises the most control. It's most control. Why? Because it helps them to answer this question that how much does it cost to produce an additional unit of output? That is, if now I decide instead of 10 units, let me produce one extra unit. So one extra unit, how much extra will it cost me, will be answered by your marginal cost. Marginal cost is the slope of your total cost because it is measuring what is the change in total cost because one extra unit of output is being produced. So you are moving from one point of the total cost to another point of the total cost. So that change in the total cost because you have produced one extra unit is called as the slope. So MC or marginal cost is also called as the slope of total cost curve. Now, let us see these curves. We have already talked about your average total cost curve, which we saw was a U-shaped curve, right? Marginal cost curve is also a U-shaped curve. It is also a U-shaped curve, indicating that as you produce more, every additional person who's coming in, that is his marginal product, is rising, or every new person you are adding in order to produce more, he is adding more to your output and less to the cost. So his addition to the output is more. This x-axis has a greater point than the y-axis. So marginal cost first falls, means as and as we produce more and more of a particular product, every extra unit is adding less to the cost, right? So marginal cost is falling. It reaches a minimum point, and then if we produce more after this minimum point, your marginal cost starts rising. That is, every extra person or every extra unit of output that you are producing is adding more to your cost rather than to your output. And if you carefully see these both the curves, what do you see? We see that the marginal cost curve intersects the average total cost curve or the average cost curve when the average cost is minimum. The point where average cost is minimum, marginal cost curve will intersect it. Or we can say that when average cost is minimum, at that time average cost becomes equal to the marginal cost. And again you see, when your average cost is falling or when your marginal cost is falling, your average cost is falling and your marginal cost is below your average cost curve. See, if your average cost is falling, marginal cost curve is below your average cost curve. When your average cost is rising, marginal cost is above your average cost curve. Yes? And when marginal cost is equal to average cost, at that time, average cost is minimum. Why does this happen? See, marginal cost is taking into account change in only one unit. Whereas average cost is taking, how do we get average cost? It is total cost divided by the total quantity produced. So it's an average of whatever we are producing. So the rate of change of marginal cost is faster because it is taking into consideration only change in one unit. Also, if you can visualize your law variable proportion diagram, there we had seen that AP relationship between average product and marginal product. They were inverted use. So basically there we saw that marginal product becomes maximum when MP becomes equal to it, or marginal product becomes equal to it. So that was the highest point of average product. Here average cost is minimum, at that time marginal cost is equal to it. So basically AP MP is a mirror image of MC and AC, because ultimately what is cost? Cost is a derived relationship of the production. Okay, so what did we see in this graph? We saw that marginal cost rises with the amount of output produced. This reflects the property of diminishing marginal product. That is, as and as you hire more of a worker, keeping the other input constant, initially he will add more and then he will keep on adding less. So when diminishing marginal product sets in, your marginal cost starts rising. Okay, but before that, when the increasing returns are there, at that time the marginal cost is falling. Second, we saw that the bottom of the U-shaped average total cost curve occurs that minimizes the average total cost. So U-shape, the minimum of average cost, shows this is the least possible cost, and at that time we have just seen AC becomes equal to MC. So the point where your average cost is minimum, we many times call it as efficient scale firm. That is, if the firm is producing the least at the least average cost curve, means this is the best possible situation for the firm, or the firm is operating at its efficient point. So let us see all these figures that we have made again. We saw that your average fixed cost curve is a rectangular hyperbola, showing that as your output is increasing, average fixed cost is continuously declining. Then we saw your average variable cost curve, which is a U-shaped curve. Okay, and then we saw average cost curve, which is also a U-shaped curve, and the difference between ATC and AFC is AVC is your AFC. Then we saw your marginal cost curve, which is also a U-shaped curve. It cuts average cost curve when average cost curve is minimum. So this is how you explain the short run production, cost, output and cost relationship. So these are the four basic curves which we talk about: AFC, AVC, ATC and marginal cost. Now let us do a quick exercise. This is one multiple choice question to you learners, wherein I am asking you if the implicit costs are equal to total, what are implicit costs? First, are they equal to the total fixed cost? Are they only comprising of the variable cost? Are they payments for the self-employed resources, or they are greater in short run than in long run? What are implicit costs? Is it fixed cost? Is it variable cost? Is it payment of self-employment resources, or is it greater in short run than long run? What will be the answer? The answer will be C. These are the payments which are made for use of self-employed resources. Now indicate whether the following statements are true or false. Average total cost curve is inverted U. Is it inverted U? No, it is a U-shaped curve. Then marginal cost curve lies below the average cost curve. When MC is below the AC, the latter rises. That is, when MC is below AC, AC is rising. Does it happen? No. When MC is below AC, AC is falling. So answer is false. Right. Now let us quickly summarize. We said economic cost is combination of explicit and implicit cost, and we understood what is the difference between explicit and implicit cost. Thereafter, we said in short run, two types of cost will be there. One is variable, other is fixed. What is average cost? Average cost, we said, is the sum total of average variable cost and average fixed cost. And we saw that average fixed cost curve is continuously downward sloping or declining rectangular hyperbola. Short run marginal cost curve, average variable cost curve, and short run average cost curve means MC, AVC and AC. All these curves are U-shaped, indicating initially as output rises, average cost falls, and then reaching a minimum. After that, if you still produce more, if the firm still produces more, these particular costs start rising. So I hope you must have enjoyed this new concept of cost. So my dear learners, happy learning.